Hello and welcome to the Investing Master Series. My name is James Boyd. We welcome you this morning on June 9th. Aloha to you. Here I am in my Hawaii shirt. Now I know why Scott's always in a good mood. Just feels great. Mahalo. Anyway, all right, a little fun there. Scott, hopefully you're laughing. Now, just real quick as we get started, we have got Barbara Armstrong with us in the chat. Say hello, Barbara. You know Barbara. And just real quick, remember that all of us coaches do post educational content and announcements on X. Barbara will post her actually handle in the chat. There's a lot of good information on X that's shared. That's what's really nice about that. And also, we kind of post sometimes some personal things, such like I did last week. Now, just real quick as we get started, remember that when we talk about stocks, we will also talk about options. Remember that options carry a high level of risk and are not suitable for all investors. Also, understand the information here is provided for general informational purposes only. When we talk about examples, we will do those on the Paper Money software application together. The purpose of doing it together is that way you could actually learn and see if it's something you might consider for yourself. Some things you might say, no, thank you. And other things you might say, that's actually kind of something that might look to maybe go down the path further on. And Paper Money is a great way to actually do that. Now, understand when we talk about investing, investing has risk, including loss of principal. When we talk also about examples, they are just that. When we bring up, let's say, short options, remember, that's a standing obligation to sell the shares at a strike price or buy the shares at a strike price. Think covered call, think cash secured put. You got to remember, these are American style options that we will show, which means those could be assigned to sell at the strike price or assigned to buy at the strike price. Okay. These are American style options. They're not European. European is at expiration. The assignment could happen prior to. Also, remember when we talk about if we bring up examples of REITs, which we will, understand that they are similar, okay, to direct ownership of real estate, such as changes in real estate values, property taxes, okay, interest rates, such and such. And so just understand that there's similarity, but not exact. But we will bring up REITs a little bit here today, and why. Well, you'll see why in just a second. Now, we'll talk about kind of we need to look at the two sample portfolios that we have. We need to talk about the management there a little bit on stock and option and examples. Then I want to kind of break down kind of some of the things to maybe be careful of that are maybe having a risk of trending down. Then we'll also kind of talk about, is there an underlying shift underneath the current, okay, that we're actually seeing a little changing of the guard? Are we still kind of seeing a broad approach to the market? In other words, equal weight, is it showing strength? Or is it just two or three sectors that are really holding us up? Those are going to be some of the themes that we talk about here today. Now, just real quick, let's actually go to right here. Now, what I want to do is let's just bring up the first chart I'm going to bring up is the SPX EW. Okay. So the SPX EW, we're talking about the equal weighted. Okay. Now, the equal weighted actually this morning rallied up past the 10-period moving average and then actually went to the 20-period moving average. So far has faded off a little bit. Now, we know last week some of the semiconductors, you're going to see that right there. This is the area that I think many investors are trying to say, be a little careful on. Remember, yesterday we made some comments regarding, looking at the moving average, the colors. Colors of those moving averages yesterday was really red. Okay, it wasn't kind of, it was. And you're going to see actually here today, we're still kind of shaking out some of the volatility that we actually had from Friday. Now you got to remember, there's been a lot of probably gains in that area. So when things fall, stops could trigger or people manually could sell and so on. Keep an eye on that. There are some that are kind of bucking that trend, but you can kind of see the majority are kind of flagging back somewhat. Haven't broken major horizontal support, but I think if there's an area to kind of flag, it's the NASDAQ being softer, which it went up 35% in 45 days, okay? So you got to understand, you go up that much, you can go down, okay? And the semiconductors, we don't have a ton of risk in that area, okay, at least right now, but that's something to actually watch. The question we want to kind of ask ourselves is, are they shifting to other areas, okay? Think of investing as teeter-totter, right? You get one side to go down, the other side goes up typically. Well, what's going up? We got to ask ourselves, okay? Now, if I pull this up and say Dow Jones, are we getting a little move? I wouldn't say a move. I mean, green candles so far, not above the moving averages, still the same as yesterday, still red candles. We actually pulled the Russell. Is it actually reversing? Tried to this morning so far. Red candles on the moving averages so far. So if we're talking about indexes, we do not see the index being or bucking. We don't see any of them where the moving averages are green. Just telling ourselves the brutal truth. Now, if that's the case, that means on individual positions, there could be some selling pressure. We want to know that. I mean, when the indexes go up, a lot of the positions tend to do good. When the indexes pull back, a lot of the positions tend to pull back. So just by watching the indexes, that kind of tells us, are we more likely to be considering buying things or maybe selling things and or managing things? Super quick, when we look at the volatility, big pop on Friday, little higher low today, if you will, and those moving averages. Now notice when the index moving averages are red, the color of the moving averages on the VIX are green. Now, if you have positions, you don't necessarily like to see that. If you're looking to get in, you know this is really what you want to have to try to maybe see some new potential entry setups on new positions. Now, the one thing that we also kind of have to bring up a little bit that is getting, well, let's just kind of say tarred and feathered, okay? One of the areas that has not been that shiny is gold, okay? Gold, you're going to see that last Friday, it really broke down, okay? Pretty good, by the way. And it just hasn't even come back to retrace yet, okay? I'm going to talk about the areas of investing categorically in just a second. I'm going to show this chart, though. Think gold, think commodities, right? When we bring up, let's say, silver, what about silver? Well, silver, not high-ho silver. It's low silver, okay? That's actually breaking through that horizontal support of the 70-ish area. Some of those mining names could be at risk of even going down further. Now, we've got to ask ourselves the question, why? Okay, we'll hold that thought. Copper. Copper is actually holding up a little bit better. And the last one, just real quick, is that the slick stuff, crude oil. Now, we did notice actually something a little different with crude oil. When we saw volatility on Friday, which is usually caused by oil prices, fixed rates in the US dollar, well, we didn't see oil go up. Matter of fact, it faded. Now, that could be a telltale sign that maybe there's some dark clouds over this crude oil price. Now, I'm not going to say we've talked about it, but we have talked about it. Okay. Now, there's reasons why some investors might be speculating that that could be at a top. They're calling the top. Okay. Now, you got to remember, some people like to trade the oil prices going down, like literally itself, or something that's trying to track it. But the other way to try to be, let's say, opposite to what oil does to some degree is if you think oil is going down, long transports. Speaking of transports, well, if you look at the transports, well, here we go. And down the stretch they come. Well, all of a sudden, if you look at the transports don't seem to mind. Okay. Now you got to ask yourselves the question. Well, what in transports? Okay. Well, let's just go look just real quick. Okay. Go back to the tried and true. Go to analyze. Go back to, let's go back to just real quick. Actually, go to Market Watch. Excuse me. We're going to go to Visualize. Okay. We're just going to kind of take a look, and I'm going to start with just right now the S&P 100. Let's kind of see. Now, here's the thing. When we look at the S&P 100, I need to look for industrials. Some of these transport names are in the industrials as well. Okay. Now, if I open this up, you're going to see that there's a little box right there. We'll pull up the sectors in just a moment. Okay, industrials. We click on industrials. What do you got here? Stocks like GE, Raytheon, Lockheed, General Dynamics. Keep an eye on Triple M. That's the one we kind of made mention of yesterday. Getting a little push here. I still don't see, if we're talking about transports, the only four that we actually see transports would be UPS, FedEx, Uber, and UNP. We don't see the airlines. So let's actually go just real quick to the S&P 500, do the same idea where we just get a bigger group of stocks, go back down to industrials. There we are. So the S&P 500 would be better, okay, to really see different types of transportation.
such as ground, which we just made mention of. There's the air, okay, air freight and logistics. But then here comes that little passenger airlines, okay? Delta, UAL, and Love. Okay, now let's kind of get into. Now I'm going to come back to that area in just a second. Let's take a quick gander at just real quick the sectors. And I want to look and see if there's any questions. When we actually pull up, let's say the sectors for just a moment. Okay, we showed the semiconductors. I think many investors might be a little cautionary in that area. We might echo that sentiment. Kind of in that pullback phase. We pull up the transports. We're going to come right back to that. If we pulled up, let's say, the IXI, trying to get a little bounce there. I mean, someone likes to try to buy double bottoms. It's kind of near that area. Keep an eye on that. We pull up, let's say, the industrials. That's kind of like in the ascending triangle part of this long-term pennant pattern, if you would actually say that. Triangle-ish. We actually pull up, let's say, the basic materials. Basic materials, it's not all about gold. There's just some other things there. It's not actually reversing super strong. You look at industrials, keep an eye, we just made mention of that. Keep an eye on the industrials, probably more than basic materials. You look at the IXV, now that's where we've kind of seen some difference there. Historically, we didn't do anything, okay? We based, and a lot of times basing can take 2 to 4 months of basing. Well, there's your breakout 3 days ago, okay, on Friday. Today, so far, would really be the higher low. Now, if you think about healthcare, you're probably thinking about UNH. UNH, if we pull that up, there she is, okay? We talked about that yesterday, getting a little push here. Now, that's not the only name, but I think a lot of people probably think about some of those healthcare providers. Now, if I'm also going to bring up just real quick, well, what about the IXM? That is an area that we're going to continue to watch, okay? But the one that's actually, now, by the way, there are some names in that area that have started to get a push. And the one that kind of stood out a lot this morning is $IXRE. $IXRE, here you go, kind of doing a bullish engulfing candle, if you will, up near the area of resistance. Now, if you go back to that S&P 500, let's pull that up. And now if we pull this up and let's go down to real estate for just a moment, there it is. Okay, I mean, it's so bright. I mean, it can hurt your eyes a little bit. That would, now if you have, by the way, if you pulled this up, if you went through your protocols, right, you go look at the S&P 500 and you're looking at the top, and you would start to really see quite a few names in the real estate and the home builder space, okay? Wouldn't take a whole lot to see that. When we actually look at, let's say, the sectors for just a moment, where did real estate land? Well, if we rank by percentage, where did it land? It was at the top. So if you did your kind of routine at all, it wouldn't be very hard to see that, okay? Now, are there any questions? Now, there was a question. I'm going to write this down. Some of these things might not be in order, okay? So I'm just going to, there's a question on Oracle, okay? We're going to come back to that one. Now, the comment was actually on pharma. Now, just real quick on the pharma front, if we went back to, let's say, healthcare, pulled that back up, and if we were to ask a question, well, what about pharma? What about it, right? So we'll pull this up, if we kind of said which ones are kind of standing out in that space. Now, let's kind of highlight just real quick. I'm sorry. I'm kind of a paper. Well, I like to write things down. Lilly, Johnson, and I'm going to actually write here the ZTS, which is here at the bottom, and then PFE. If we were to look at this like pharma, okay, is that where we're really getting the push? Well, a lot of actually where we're getting the push right now tends to be kind of a little bit more healthcare equipment and life sciences. That's where we're seeing a little bit more green, okay? Now, if we said, well, what about the pharma? Now, by the way, there are some industry groups that are tradable. Beware those symbols to actually look at the pharma. If we were to look at a couple of these stocks and just kind of say, are any of those really getting a push? Lilly, higher price stock, but it's just touched a brand new high yesterday. Well, what about Johnson & Johnson, the big Johnson? Now, let's start here. Okay, let's hold that thought. I'll come back to that one in just a sec. What about ZTS? That was the strongest one. That's in a downtrend. It's up today, though, and PFE. All right, now, if we kind of said which one is kind of showing a little bit more bullishness outside Lilly, it's the Big Johnson. Now, if we take a look at this, so first off, let's go back to, let's start here in our example. Since we're talking about healthcare, we already talked about UNH yesterday. Let's kind of branch into the pharma for just a second. Now, let's start with the 3-year weekly chart. There she is. Okay, now, a lot of people like to kind of have the backing of the weekly chart. Makes sense, okay? You're trying to put all the odds in your favor. All the odds doesn't mean it's going to go up. You're just trying to put all the odds in your favor. Now, if we look at this on a weekly chart, tell me what you see. Barbara, don't tell me what you see. Now, if we take a look at this, if we're just, I know nothing, okay? If we looked at this and said, look, I don't know a whole lot, but I kind of see that we went from red to green. That was about 4 weeks ago, right there. If we actually kind of say, what else do we see? We kind of see the moving average crossed over. There's another one. And you're actually going to kind of see that right now, we're trying to really get above these prior highs. Now, one thing I also want to kind of highlight so far for the week, since we're looking at weekly candles, the intra-week candle, here we are on Tuesday, is kind of tippy-toeing all over that moving average. Now, some people might be using that support, place to set a stop, and so on. So we're kind of seeing a little reversal. If you actually sit, BJ actually gets it before I even made mention of it. Kind of seeing a little divergence on the chart. And yes, it is, isn't it, BJ? Now, some people kind of like that, okay? They like to kind of see where the momentum is turning to the upside. Now, let's actually, so first of all, that's the kind of technical layout on the 1 year, 3-year weekly chart. Let me delete that. Let's actually close that. Let's actually go back to that 1 year daily. Why did I start here? Well, if you like to say the word diagonal with a Wisconsin accent, you're going to now notice this kind of has like a diagonal slant to it. How many of you saw that before we ever kind of really dug into it? Now, why is that of interest? Well, some people kind of like to see if they have a diagonal line or diagonal resistance, they're looking for channels. Some of you like horizontal breakouts. Some like diagonal breakouts. If you were to say which one is your favorite, yes. Wait, which one? Horizontal or diagonal? Yes. Okay. Now, which one is your favorite? Well, some people might like that diagonal. Now, here's the deal. We got to ask ourselves the strategy now, right? You can look at all you want. It doesn't mean anything. Well, if we take a look at this, let's go to the just trade tab just real quick. I want to kind of take a look at what's the volume so far. Remember, we're looking for average volume of over 1 million. Okay, over 1 million. Second, we're looking for a bid-ask spread, pennies wide on the stock. Okay, it is a little wider than you'd probably like to see if we're talking about stocks, but it's a $234 stock, but sometimes it could be penny wide. Second thing was when we look at this, we actually look at the implied volatility. For a lot of the things we actually look at, the implied volatility has been, recently on many of the stocks we look at, over 35. This is one of the lower ones. Without even looking, we're thinking that kind of opens up some strategies. Can anyone tell me what strategies might be more applicable in little, maybe low to mid volatility? So when I look at that percentage on the right-hand side, my mind thinks 3 buckets. 15 to 24 volatility, low volatility. Medium 25 to 34, high volatility 35 plus. So here we are. If we went out 40 days, about 40 days to expiration on the monthly options, we're going to go over here to the right and say, where are we in that categorization? Okay, well, 27. We're in the mid-range. If we're in that mid-range, some investors might say, hey, could buy the shares of the stock, might buy the put. If you buy the shares of the stock plus the put at the same time, what do you call that? Okay, shares of stock plus you buy the put. It's called a married put, right? So that might be a strategy. Well, why is that of interest? Well, if the lower the volatility, the lower the puts premiums are,
the lower the put premium, the less the stock has to go up to break even. Second, well, could you collar the position? Could you buy the shares and collar it at the same time? Sure. Okay, we'll show a past example of that in just a moment. The other one might kind of be in this case is, could I do a covered call since it's mid-range? Could, caps the position out in terms of the maximum gain. But if it's kind of mid-range, if we talk about selling puts or doing cash secured short put verticals, just the premiums are not going to be as big. Some investors, they also might like something like buying a long call, for crying out loud, which is the right to buy the shares at the strike price from now until expiration if you place that position. So let's hope. Now, we just made an assumption. We just talked about strategy. I need to go double check now the volatility. No, not the volatility. We need to go check the volume. Well, what's that volume like? And that volume is going to really affect the bid-ask spread. Now, when we actually do this, we like to kind of look at the at-the-money on the call, the at-the-money on the put side. So I'm going to kind of just put it right there. I got 85 cents really on the 230s. Calls, 85 cents on the puts. I got about 60 cents on the calls. Those are not narrow, okay? Now, the open interest is still over 6,000, but so far, at least on the at-the-money strikes, not a ton of activity. Keyword is yet. 50 cents actually on the out-of-the-money strike right there, okay? Right there is a little tighter. So it's not the at-the-money. If we look at what's the next one out of the money at the 220, it's really, in this case, about 33 cents, okay? So every strike is not the same in terms of the liquidity, the open interest, the volume, and the bid-ask spread. So there can be differences in terms of where people have demand for certain strikes. Now, what I'm going to kind of do is, let's say the investor were to say, you know what, James, I want to try to buy the shares of stock. And what we're going to do in this case is, now sometimes we've talked about this, sometimes people say, you know what, James, I want to try to get in, but I want to just protect myself just in case, okay? Now, if I were to look at this, we're going to go to the trade tab, okay? And now what we're going to do is, now I'm going to show this in two different ways, okay? If we were to say we're going to click on the ask price, number one, and number two is we're going to come in here and say first triggers SEQ. So step one, all we did right there is just click on the ask price. Click on the ask price of the stock. We get the stock information down there that we're buying the shares of the stock. Step one. Step two, what we're going to do is go down to first triggers SEQ, meaning do it in a sequence. First, buy the shares. Two, well, we're going to buy the put to the downside. Well, that put to the downside, if you take a look at this, is about 240-ish, okay? Now, if we did this, okay, click on that right there, and now what you're going to see is when we do this, you're now going to see there's the position. And I'm going to change this down to about 240. I'm going to make it, try to make it easy math, 245. So if we buy the shares at 234.68, and then we add that put price, we would need the stock to go up to what? Answer, add them together. At expiration, we need the stock to go up to 237.13. Now, if the stock right now is at 234.70, you know, that's not a lot. The way you could double check that is if you said, okay, if I pay 245 and we're buying the shares at 234.68, what percent is that? It's 1%, 0.01. Now, how do we know that was probably going to be somewhat the case? Well, because the implied volatility was lower. So when that implied volatility is in maybe in the low to mid range, some people might say, look, I want that downside protection just in case. Okay. Now, if this was a stock that had an implied volatility 60, 70, 80, 100, what, the numbers are probably not going to work to meet the criteria that we talked about at the beginning of the year. Okay. So step number one is we're going to actually go click on the confirm and send. There's the position. You buy the shares and you buy the put at the same time. We really actually got in this case. Now, by the way, as we talked about the markets kind of pulling back, we said that yesterday, we're saying that today, shifting, right? Now remember,
name the 3 to 4 sectors that tend to be somewhat inversely correlated to the market to a degree. It's utilities, staples, healthcare, and real estate. If these are going up, it's just more confirmation that the market could be pulling back somewhat, a little bit. Okay. Now, that doesn't mean it's bear market. Okay. Here comes O2. But the biggest actually thing is sometimes you have some of those growth areas that explode. And they did. Okay. Now, what happens is it's kind of more boom and bust. Okay. When those things are pulling back, it doesn't mean they just sit there and sit in cash forever. They just changing some of the positions that they were buying. 1 minute they're actually buying tech names. The next minute they might be buying some of these tech and real estate. The moral of the story is they're trying to get the account to move higher. Hello? Okay, now we'll go ahead and send. Now, the one thing is, if I also want to kind of go back and say, could someone maybe try to do an out of the money call on this? And I'm going to kind of maybe do like the 240. Let's kind of show this in this portfolio. Wonder if you wanted to kind of do the 240. Okay, if we actually bought a call, well, what's the most you could lose? Well, if I'm talking about the option piece, well, the most we could actually lose is $580 or $580. The $580 gives us the right to buy the shares at the strike price. Now, remember, when you actually buy that call, let's say now, currently, statistically, the odds of that stock being above the strike at expiration is 42%. Okay? And that means the stock closing 1 penny above the strike price. If we said, what's the likelihood of the stock touching that? It's going to be about double what the delta is. Okay, so I said 42. If we double that, it'd be 84. It's not 84, it's at 79. So the chances from now to expiration that we could come up potentially, as of right now, that we could come up to the 240 is about 79%. Well, why do we care? Well, of course we would care, because if we actually have a long call, you want the stock to go up, so it actually has a greater chance to be in the money. Greater chance to be in the money, the option premium goes up. And the biggest actually thing is we want the move to be slow. Wrong answer. We want the move to be fast. Okay? So what we're going to do is on this one, we're going to go confirm and send. We don't normally buy a long call in our examples, but we're going to show that. The pro of that, unlimited upside. The con, negative time decay. Other pro, positive vega. Volatility actually goes up. The option could potentially increase in value as well. So there's 2 pros: unlimited upside, positive vega. Con, you want the move to be quick because that time decay. Now, let's actually go back to just real quick the airlines for just a second. So let's kind of go back to kind of the thing that we're watching, which is that crude oil stuff. Now, some might be long airlines. I don't know who you are. Speak now or forever hold your peace. Now, if we were to look at, let's say, airlines, I'm going to go back to, let's show 3, and then you tell me which ones stand out to you, or any. Let's bring up Love. Let's start there, okay? If we look at Love, you're going to notice that there's an existing position. We have a target and a stop. If I went back to that and said, where's that position? We're down 220 on that, okay? Now, it's not the end of the world, but we're down 220 on that. Where's the stop? Just to make sure it's not cheating. Well, you're going to see that it's right there. And if I went back just double check this, and I just want to make sure this isn't something that should have been exited, and I haven't looked at it since, and I'm going to move up the stop. So if we go back to that 4th chart in, and I wasn't here to see this, but if we go back and say, where could the stop be moved up to based upon the lows? Well, the stop could be moved up to right there. There being 40.82. Now that is going to be tight, okay? But if we kind of moved it up to where that 10-day low is, it's right at 40.82, okay? So if we send that, it's giving about just a little bit more for it to play out. About another $100 of potential risk, assuming the stop fills. So that's not one that's right now kind of getting a little love. We went back to Delta. You're going to see on that case, we rallied up to the 20 period moving average, faded. And if we actually look at UAL, we're kind of seeing that as well. So at least right now, we don't see the airlines getting a push right now. Okay. So we're going to kind of hold off on that. We don't see the push. Now, I want to go back to kind of one of the ones that is kind of showing some potential, I'm going to use the word risk. Okay. Now, you got to go back to this chart, two of them, NASDAQ, okay? Remember, what happens with the NASDAQ can affect the other indexes. Let's just be brutally honest, right? Now, if I pulled up, let's say, the stocks, what happens with the semiconductors can influence the risk-taking behavior of other investors that are looking to buy other things or semis in general. I'm going to go back to just real quick Cisco for just a second, and let's kind of talk about an example trade. Now, a lot of the example trades that we look at are bullish. Why do you think that is, Clark? Okay. Well, why? Because a lot of times the market tends to go up. Not all the time, but a lot. So the majority of our examples in the current market condition have been bullish. Now, we want to be prepared that if certain things were to happen, like trend changes, prices pull back, what are some of those maybe potential go-to strategies? So number one is we got to at least say, look, if we're bullish, do you understand stops? Do you understand protection? Do you understand what the bearish charts look like? Okay. So what do the bearish charts look like? Stop adjustment and exits, right? Risk management. Okay. If you said, okay, but we don't have a bullish position, we're looking to do a bearish position. Now, let's say, example given, the investor said, James, I want to do a bearish example trade. Well, why would you do that? Well, you might say, James, I think some of these things are at risk of falling down. Just because they fall down, it doesn't mean that the trend is over. Now, the dangerous part about this is if you have something that's upward trending, it might not fall down as far as you think. Now, I'm going to kind of show just real quick. So the comment was on Oracle, right? And just, hey, if Oracle announces earnings and the earnings are maybe bad, whatever, how does it affect the tech space? Well, definitely it's kind of like, a ripple effect in the water, right? It could affect what they think the other earnings could be. When we talk about bearish strategies, we talk about short call vertical, long put vertical. Those would be probably the first two as example trades. They do not require a stock position. Hallelujah. Okay. Now, what I'm going to do in this case is, let's say the investor said, James, I think, the investor says, that Cisco could fall down. I don't have the position, but I'm going to place a bearish option trade. Remember, two to maybe practice: short call vertical, long put vertical. That short call vertical, if we said, look, we're going to sell the 125 call, that's where you think the price could stay below. Now, we're going to do two examples of this, okay? Two bearish examples. If we sold the 125 and then, let's say, bought the strike above it, well, what is that? It's the 130, okay? Why would you choose a $5 wide strike or a $10 wide strike? Well, if we could choose a $10 wide strike, if we could take that risk. What is the risk? Well, that risk is 361. Can you take that risk? If the answer is, I can take $1,000 worth of risk, then you definitely might consider actually opening it up more, assuming that there is liquidity on that, okay? The way to double check the liquidity, let's go back to open interest. Is there liquidity on the 130 and the 135? And we probably say yes. So if we said, hey, we're going to go in and do the 125, 135, credit there 229, confirm send, and now we see what the risk is. So the investor has to ask themselves, can I go out to $10 wide strike? That's assuming that you could take that risk. Second, you verify actually what's the open interest volume spread look like to double check. Don't assume, you check. Okay. If we did that trade, a bearish trade, it's going to be actually Cisco, $1.30 for the commission because we're selling the call and buying the call. Buying the put, excuse me. Now, if we take a look at this, we're going to go send. Now, what we got to understand something just real quick is when there's a difference between, let's say, stocks that have been upward trending, and I'm just going to kind of show this for just a second, okay? So if I looked at a stock that's kind of being talked about in the chat is, hey, Dell is dropping down. Now, again, this is why I kind of used the language yesterday. We have to be brutally honest with ourselves, okay? Well, what do you mean by that? Now, remember, if you see the shorter term moving average red, that means you have negative momentum. It's been there right on the chart, okay? The con about negative momentum is price is below the short term moving average. Why is that such a big deal? Well, you're going to notice a lot of times is you don't get the stock to just go up and up and up and up. If it goes up, it tends to go up for 1 to 3 days and then the red candles come back in. That's the negative part, okay? Now, we got to speak to this for just a second because if we got things coming down, well, we wouldn't want to say, do we have any positions in the paper money portfolio that might be maybe, we don't want to be foolish here. I'm going to bring this up because we have a position. We have the 200 and the 195. Now, this sounds ludicrous that we would look at this and say, well, the stock is at 378, James. You sold the 200. There's no way on earth. Just let the position play itself out. And that sounds lazy to me. Because just because you have more time, that does not assume that you're at the cap gain anyway. So the moral of the story is if you have time remaining, could hell freeze over? Yeah, you better believe it, okay? And the other thing is, even if you said, I'm going to wait the next 9 days, you're now going to notice is it doesn't matter what we think because we can't really make any more that's material, okay? Now, we always talk about this. If you can buy the short option back for a nickel or less, it should be commission less. By buying that back, what we're doing is we're actually taking that risk off, okay, of the price falling down and hurting the gains on the position. So step one that we're going to do here is if we go to mid, we're going to try to buy it back for 5 cents. When was that position placed? The answer is there, right there. Now, I'm going to go confirm and send. If we buy it back, it should be commissionless, assuming we could buy it back for 5 cents or less. We're about ready to find out. When I say 5 cents, I'm saying $5, okay? Now, we're going to go ahead and send that order, and we're going to see if that fills. Now, the other one I want to double check just real quick that's also kind of up there as well is if we take a look at, let's say, the AXP example. The AXP is really sitting about 43%. Remember, we talk about getting out 4 to 10 days to expiration, okay? Now, if we look at that, if I close that for just a second, that is where are we? We're at the 310. Remember, that 310, that is a standing obligation to buy those shares at that strike price. Well, if you're saying, you know what, I'd rather just take the $262 and go out to the next month or go to another position, well, we're inside the window 4 to 10 days. Yeah, but I didn't make all of it. That kind of sounds like if you have children, but I want more. Or I'm pouting, right? Or like a grandkid, okay? My kids don't pout. I'm joking. They do. They do. And the biggest thing, and I did too as a kid, okay? So the big thing is when we look at this, we're inside the window of exiting. We would like to get 100%, but sometimes that's not always the case if you've run out of time. The second thing where we're going to do on that just the second position here, right click on that, create closing order, we're going to buy it back. Now, sometimes you also got to ask yourself is, Are there any positions that are maybe under pressure where you say, I don't want that obligation anymore? Example given, two of them. The one that's actually kind of showing some pressure is Microsoft, okay, which has 38 days. But the one that we might be a little bit more concerned about that is inside 4 to 10 days expiration is NVIDIA. Now, nobody likes you to lose anything, okay? But sometimes you're saying, I'd rather lose a little bit than have that become a bigger loss. And the other part of this is you might say, James, I don't like the trend. Well, let's pull it up. Let's see what we got. Now, we pull this up and say, NVIDIA, what do we see? When you look at NVIDIA, red moving average colors, okay? Now, this looked better last week. Right now, ooh, red candles. This is not the greatest setup when you see this green candle for one day and the very next day, smash red to the downside. Red, red. That is not great, okay? Because remember, if you only see up candles or green candles for 1 to 3 days or less and then selling pressure immediately, okay, you have negative momentum, okay? So what we're going to do on this, since we're inside the window of, again, 4 to 10 days expiration, we're going to say, you know what? Don't want to lose anything, but we don't want to kind of be stuck in a position where this could morph into shares of stock at the strike price, number one. Two, it could turn into a bigger loss, okay? And this is where sometimes the investor needs to recognize you've run out of time. What your idea was, it hasn't played out, and you're just saying, look, I want to kind of exit the position, no harm, no foul, not really, and just go look for something that's kind of more along the lines of your normal setup anyway. This is not playing out, okay? Some of us, I'm looking at you, need to recognize taking small losses, that's probably not really going to hurt the portfolio that bad. It's taking big losses, okay? Now, it kind of sounds stupid, but if we kind of said, look, if we lost $82.50 on a portfolio of 48,519, how much are we talking about here? The answer is it's 1/10 of 1% or 0.2% if we round it up. Could barely feel it, okay? So now what we're going to do is going to go confirm and send the order. Yeah, that's true. That's true, Ray. This is the Tommy shirts. Exactly. I'm still in aloha mentality. Now, if we take a look at this, we're going to go ahead and send that order. Now, the other thing is the comment that was actually mentioned in the chat was CrowdStrike. Now, remember, CrowdStrike, again, being brutally honest, that has also been mimicking other tech-like stocks, the red lines on the moving averages, right? Well, the red lines on the moving averages, negative momentum, trend pulling back. This goes back to stop adjustments, risk management, like you're going to maybe overlay some options on top to protect it, or you're just going to exit in general, okay? The red lines on the moving averages are telling us that momentum is down, bearish, and trend, we're in the pullback. Now, the reason why I looked at the chat, I do think it's worth to actually bring this up. The CrowdStrike 4-to-1 stock split on that. Keep an eye on that. Now, if you look at the move that CrowdStrike actually had, and again, I'm just talking about in the last, let's say, 60 days? CrowdStrike from low to high was 115% in 36 trading days. So that means in a month and a half, massive moves. So you got to understand that when you get these big moves like this and you finally start breaking support, it's not completely unusual to see some selling because people are trying to grab any of those gains that they have accrued in that rally. Even if they said, look, I only got a quarter of that, 20%, that's still a good chunk for many investors, okay? Now, got to actually wrap this up here, but let's take a look at this. So something we're going to kind of be watching still is when you look at the S&P, we need to see the moving averages start to change color. We haven't seen that yet. So right now we're kind of in that pullback phase. Be aware of stops, risk management, okay? Be also aware that some investors might put out maybe some bearish trades overlaid on top of their sample portfolios. And also remember that what happens in the NASDAQ and the semiconductors could bleed over to those other areas. Keep an eye on healthcare and real estate, as those are kind of so far being a little area where some investors might be shifting to. Keep it also on crude oil and the commodities. So I'm out of my time here today. Don't forget to subscribe. You can do so for free. If you enjoyed today's video, click the thumbs up. Stay tuned for our next webcast on getting started with options later today. Barbara Armstrong will be teaching the class on getting started with technical analysis. Feel free to also join us tonight on night 2 of the Option Strategy Workshop online. Remember, with what we talked about, is done for example, illustrative purposes only. And this has been the class on Investor Master Series, kind of talking about pullback markets a little bit and rotation. So with that said, have a great day. Stay tuned for our next webcast coming up next.